Morning, everybody. Coming into you know, almost full house here. You guys all right?
Morning.
Hey, we're recording. What's going on? Wow. All right. How you guys feeling today?
I'm feeling good. How about everyone else? How about you?
I'm doing all right. I caught the time exactly at 10:30 just now. I was getting caught up in emails and started to flow into a pattern. Then I was like, wait a minute. Gotcha.
Hey, what's up, y'all?
Peace, good morning.
Morning. How you doing, Pat?
I'm doing decent.
Staying warm?
Yeah, trying.
Mhm.
It's officially spring.
Yeah. We're always saying that the third Tuesday is a good one. We always get the auspicious days, So it's very good to be connected to the third Tuesday. We keep getting the 21st. Last month was the 21st, so it's a good vibe. By the way, Pat, can we spotlight Neha and Todd?
Yep.
Are you presenting a deck and things?
Yeah, we'll have a PowerPoint or the Google version.
Gotcha, sheets. So yeah, you guys can be spotlighted, and even if you present, it's not going to show the spotlight, but for the recording and for the audience, once you finish recording, it'll be your two faces. And this will go to the community, so it has a lot of value being recorded. We're building up our backlog of content that we can really utilize.
Yeah, I was actually, so we also prepared sort of a handout in addition to and the handout is also linked in and it is a PowerPoint, actually. I just remembered, but I did want to make it so that I don't know how the best way to do this, but to make these both as sort of downloadable content, whether it's in the show notes when it's eventually turned into a YouTube or whatever, but we do want these materials to be publicly available in whichever way is sort of easiest from your end as the technology savvy folks. I'm a lawyer. I don't understand it.
Absolutely. We're good on that, Pat?
Yep.
Cool. All right. So folks are, as usual, going to continue to trickle in. We've got a few folks in the room. Just want to say good morning and welcome to the Co-op Connection. Today, we've got some folks in our community who will be presenting on specific topics related to business and laws. We're hoping that folks, especially startup folks, especially sole proprietor folks, can get a lot of value from this, and you can access this on our YouTube channel. So we expect this part to maybe run up until 10:20. We'll see. And then maybe we'll be able to get some community updates from our fellow and any final thoughts after that. So if you have questions, you let them know how to handle that, write them down, drop them in the chat. I can keep an eye on that for you and we can bring it up at the end. Or would you like to handle it as you go?
Whatever. We were thinking Q&A at the end, but okay. If it's an urgent question, put it in the chat if that's comfortable. If it absolutely has to get out, please raise your hand. But otherwise, we were hoping to address sort of all Q&A at the end in case it's answered, as through the course of the presentation.
Absolutely. I'll keep an eye on that, and I'll just plan to bring it up at the end. All right. Thank you guys so much for dedicating your time and expertise to this. I think it'll be really valuable. And I think we can get started to provide the maximum use of this moment together. So let me get out of your way. But before I do, any questions or any thoughts from anybody in the membership before we begin, or is everyone good to go? All right, me too. So thank you for being here. please share a little bit of your expertise with us.
Perfect.
Perfect.
Should I share the screen now or
Yeah, do you need permission or are you okay with that?
hang on, let me try. Can you see? Can everybody see my screen?
Looks good.
Perfect.
Great. So yeah, so we wanted to talk about the prompt that led us to put this together was, what for entrepreneurs, especially emerging entrepreneurs first starting out, working independently as well as with other people, what are sort of things that would be useful and important to know. For that reason, as well as, taking advantage of the expertise that my colleague Neha, as a tax law specialist, and recognizing that in my experience as sort of a general corporate finance, transactional CED attorney, a lot of the questions that I end up fielding from folks that are just starting out are actually, they're really more tax area questions, even more so than tax law, sort of, tax compliance, which is more of an accounting, specialization. But in order to sort of recognizing that there's a lot of questions about, okay, we're doing this business, we sort of understand how, socially we work together and, or independently, I know how to run my business and I learn how to run a business with my, co-workers, co-owners. But, it sort of seems like the purpose of this is to help fill in maybe, so how does the IRS look at what we're doing? How does tax law conceive of what a business is, what a sole proprietor is, what working with other people is, and the role that sort of state law created, what's known as juridical entities, business entities, LLCs, corporations, cooperative corporations. I think there's more familiarity around that for folks first starting out than there is the tax piece. And so we really wanted to zoom in on, okay, what are some basics that would be really useful if I'm just starting out? And so you can see we're going to have a brief digression just to give us, the overview types of all of the business entities, which again are sort of state law created legal fictions, but they have reality because they have legal impact. It changes how the world treats you, the government and other people, how courts are going to look at you. But then we'll focus specifically on the types of either business entities or lack thereof in the case of, some kinds of sole proprietorships where you don't even create a legal entity, that are going to be most commonly encountered by folks just starting out. And so talk about working alone, sole proprietorships, which are from the tax, the IRS's perspective, disregarded. There's no separation between you and your business. And that is true whether you're just do it as an individual, or if you use an LLC that's a sole member and you don't do anything additional, is the default treatment. And Neha is going to step us through that, as well as the critical important piece, which is self-employment taxes and reporting your self-employment income. She'll also talk about how to, entering into business with other people in that same lens of what's most likely going to come across, what ish situations are I'm most likely going to come across just starting out, and that's likely multi-member LLCs. And we'll talk about when you have a multi-member LLC as opposed to just a sole member LLC, what the default tax rules are. You can see the preview here, partnership tax law, subchapter K, and we'll also continue talking. She'll also talk about self-employment taxes in that context. And there'll be a final brief discussion on how public benefits, we'll be using the example of Social Security, disability, especially through the SSA, to sort of highlight some fundamental concepts. But I want to be clear that the purpose of this is not to provide legal advice on how to do any of these things or what a solution for you would look like, especially when we start talking about, the nature of benefits. It's going to be a highly individualized, analysis about what the best approach for anyone is. This is really just fundamental concepts. So with that disclaimer, lawyers love disclaimers. I'll just do a brief note. So I discussed, the state law versus federal tax law. That's a fundamental distinction that should always be kept in mind when we talk about a corporation or an LLC. That is a state law concept. Under state law, there's a whole host, depending on the state you're in New York State, there's a whole host of entity options you can have to house, to own your business, to run a business through. The first one being just do it yourself, don't do anything. Sole proprietorship, where you just start running a business yourself without a state law entity. You can also run a sole proprietorship through an LLC that you just own completely. There's other options under state law like general partnerships, limited partnerships, and of course the LLC. And then there's, the corporation, business corporation. And then in New York State, there's also cooperative corporations, which are sort of a statutory modification of the business corporation. We won't be focusing on general partnerships, limited partnerships. If we're talking about partnerships in the context of this, it's mostly going to be talking about partnership tax law, which again is a separate, that's federal tax law versus state law. We won't be addressing corporations in depth or cooperatives. The idea is that we'll be focusing on what you're most likely to be dealing with first starting out. Not necessarily saying that that's always going to be the best option, especially when we get into more complex individualized situations, such as when you have, public benefits that you're trying to not have your business activities adversely impact or be adversely impacted by. But sometimes it will be the right answer to it's not so much that you always start out with an LLC and then when you're big enough, you move to a corporation. Sometimes that's the right answer, but sometimes the right answer will be, it'll be a very individualized decision. But on balance, there's a reason why we're focusing on just sole props and LLCs, because that's most likely what you're going to be navigating. Next slide, please. And so with this, I'm going to hand it off to my esteemed colleague, Meha.
Good morning, everybody, and thank you, Todd. Can you all hear me okay? Wonderful. So working alone, solo, single person, sole proprietorship. So it is a type of business where definitely there is no separation between the individual and the business. What that means is that the owner is responsible for all the losses, faces the creditors. On the flip side, the owner enjoys all the profit. And another advantage of being the sole proprietor is that it is easy to set up, very low administrative costs. Few things to keep in mind are obviously the tax considerations. That is how you will file the taxes as a sole proprietor. I'll discuss this more in the following slides, but just so you know that you will be, if you're a sole proprietor, any income and loss from your business would be reported on Schedule C along with your Form 1040. In addition, there's also Schedule SE, which is more like a worksheet, but it helps you to determine your self-employment portion of the taxes. So generally, what are the most frequently asked questions for a sole proprietorship? Is a registration required? No, a registration generally is not required. However, if you do not use your own name and you want to use a doing business as or a DBA, your name has to be registered. And it is also advisable to use a DBA because it eases the process of opening a business checking account and doing banking for your business. So it's always advisable to register a DBA and not do everything under your own name if you choose the sole proprietorship. Now, once you grow your business as a sole proprietor, can a sole proprietorship have employees? Definitely, you can have employees. And in order to recruit the number of employees or hire a number of people, the first step is obtaining an employer identification number or an EIN from the IRS. The tax considerations and the forms. So like I said, there is no tax at the business level. The business income and losses, they are reported on your personal federal income tax return, that is the Form 1040. The additional schedules that you will be using are Schedule C and Schedule SE. If you have employees, there is a quarterly filing with the IRS, which are called the withholding taxes, and you'll be using Form 941. However, if your annual withholding liability is less than $1,000, you can use just one form and file it annually instead of quarterly, and that form is Form 944. In addition, there are a couple of other forms when it comes to having employees, which are beyond the scope, but just to put it out there, like there's a Form 940 for federal unemployment taxes. At the same time, there's a SUTA form or state unemployment tax form which is filed with the New York Department of Labor. So there are different considerations, but that all depends if you hire the employees and what's your withholding portion, if it's less than 1,000, more than 1,000, and so on. Now, this is what a Schedule C looks like. It goes as a supplement to your 1040. As you can see, it's pretty simple. There's income, there's expenses, and then there's a total profit. Now, along with Schedule C, another important piece is Schedule SE. This is mostly like a worksheet, and you can easily calculate your portion of the FICA and the combined, in combination, they're called SICA taxes, which is like if you get a W-2, your employer withholds that because you are a sole proprietor, you'll be responsible for paying the employers and the employee portion of the SICA taxes, which should be reported on Schedule SE. Now, the next piece is going into business with other people. Like, what if I open a business with another individual or few more individuals? How will I be treated in the eyes of IRS and at the state level? So you'll be treated like a partnership. That's a default treatment that you will receive unless you make an election on the Form 8832. You can be treated as a corporation. You can choose to be treated as a C corporation or an S corporation, depending on your requirement and your circumstances. But your default treatment is going to be a partnership. So why do people choose LLCs? Like Todd mentioned, LLCs are essentially state creatures. They are a product of state law. They came into being sometime in 1970s, and they're relatively new, less case law, and allow you to do a number of things. There are a lot of moving pieces when we talk about LLCs. So as I mentioned, that they are usually taxed like partnerships. However, since 1977, the IRS has given an option to choose whether you want to be taxed as a C Corp or an S Corp. And rather than, taking direct distributions from your business, do you want to take dividends and pay capital gains and record capital losses on your income tax return? A little complicated part is the accounting requirements for the LLCs. Now, if you are like a startup and you just have one or two partners and, there's not there is not much complication. But if your business grows and you have more members and the number of members increase, you have to be very sure that you are tracking your capital accounts. Contributions into the business will increase your capital account. Profit and distributions will increase, but withdrawals, profit allocation will increase your capital account, but withdrawals and distributions is going to decrease your capital account. Now, why is capital account important? Why the maintenance is important is if a member decides to sell or withdraw his membership interest. So at that point, your capital account will determine your cost basis and your selling price, and whether you'll be taxed, whether IRS or the state tax authorities are going to tax you. It will all depend on the net balance in your capital account. So it's very important to make sure that your capital accounts are reported to the IRS. It's the sooner the better, and it's usually reported on Schedule M1 on a partnership return. The startup costs can be an issue if it's a relatively simple LLC, like a single member or few members. It's not a problem. But if you have multiple members, like say 10, 15, 20, you will be required to, it's always advisable to have an operating agreement, a membership agreement, like who is going to do what, and what are your management requirements going to be. So the startup costs tend to be a little high with the LLCs. The default management treatment for a LLC is member managed, unless you have an operating agreement that says otherwise. Now, why a limited liability company? Because it's very flexible. Generally, whatever is in your operating agreement governs how you will run your business. So it's governed by the state's LLC statute. New York has a publishing requirement whereby any new LLCs has to be published for 6 weeks in a newspaper. Owners are called members, and their interests are called LLC interest or membership units. The LLC or the business can be member managed or manager managed. Generally, by default, it's member managed, but if you have an operating agreement in place, you can say that it's manager managed, and amongst your members or even outside, you can hire an outsider to manage your LLC, and then it will be like a manager managed LLC. Or you can hire from within your own members, and you'll be like, okay, 1 or 2 people or 3 people, they will be taking care of the management, they'll be running everything. The other people are maybe they're just passive members, or they're investors. They don't want to do with the working and management of the business. So that's where the manager managed LLCs come into being. So you have to file an articles of organization with the New York Secretary of State. And this is what it looks like, LLC SOS filing with the New York Department of State. Like I discussed, LLC can be member managed and manager managed. Default rule tends to be managed by the members. Generally, manager managed LLCs are involved where we have a lot of investors, and they do not want to be a part of the management, and they're just limited partners. What happens in that scenario is those limited investors or partners or members, they are not subject to self-employment taxes because they are not considered employed or self-employed by the LLCs. So now the fun part, the tax filing for an LLC. The tax form that we use is a 1065. The due date has just passed. It was March 15th. It's March 15th of every year. If it falls on a Sunday or a public holiday, then it's generally the next working day. Majority of the partnerships file an extension because partnership returns can get complicated. Multiple partners, complicated capital accounts. So how you can do that? It's a very simple form. It's a form called 7004, should be filed on or before the due date, and you will automatically, your business will get an extension for 6 months. Now, Form 1065 is just an informational return. You do not pay any taxes to the IRS when you're filing Form 1065. It is stated in the IRC, that is Internal Revenue Code, Section 701, that a partnership as such shall not be subject to income tax imposed by this chapter. Persons carrying on business as partners shall be liable to income tax only in their separate or individual capacities. Now, how will an individual pay taxes from an LLC? The reason why the LLCs are called pass-through is exactly for this reason. The 1065 form has additional supplements called K1s. Now, K1s are issued to the members of the LLCs. It includes a member's capital account, a member's share of profit, what are you going to distribute them, has they taken anything against their capital, and what is their portion of the self-employment tax. So everything will be listed on the K1, and then the K1 will be filed along with your 1040. So in other words, it's more like a Schedule C. Instead of a Schedule C for an LLC, you will be given a K1. Now, this is a 1065. It's a relatively bigger form than what it looks like here. And this is just one page. I think it's more than like 14 pages or something. And there's a Schedule B next to this, B1, where you have to report if any member has a majority share, like more than 50%. You have to give details about that member and, so on. So this is the form I was talking about where you file for the extension for the LLC. Like you can see here, it says Form 1065, and you'll just say that it'll automatically grant you a 6-month extension. But you have to be careful that you file it on or before March 15th. All right, so this is your Schedule K1. It's similar to Schedule C. The only difference is it is issued for an LLC. You give all the details of the member here, the member's social security item, and the name, address, whether the member is a general member or is like a member manager, or it's a limited member or other LLC member. There's their beginning capital account and then their ending capital account, any liabilities, recourse, non-recourse, and then under part 3, if you can see, there's a self-employment earnings and loss. So this is another important piece, is whatever profit you get, this is important to kind of calculate your self-employment tax portion. So this is equivalent to Schedule SE, you can say. All right, so a common question is, why do members pay, they're limited members, limited liability company, why should they be paying self-employment taxes on their portion of distribution of profits? The general rule is that partners or members in a partnership, they're not considered employees of their business. So therefore, the IRS or the state taxing authorities, they consider them self-employed. And they are generally put into the category of sole proprietors or independent contractors. In 1950s, the SECA Act was introduced to impose this 15.3% tax on self-employed individuals, independent contractors, and members of partnerships. So this is where your self-employment taxes liability come if you are a member in a LLC. Now, like I said, there are certain exclusions from self-employment tax. That is, under certain circumstances, the IRS will exempt you from the additional 15.3% tax. it's a wishy-washy area. It's not clear. Highly recommend to take expert opinion while making sure that whether you qualify as a limited partner or not. The limited partner exclusion is under the code section 1402A13, and there are a lot of exceptions that are listed there. For example, if one of the members is a trust, they don't have to pay self-employment taxes. If you have a foreign partner, they don't have to pay self-employment taxes. If you have an investor, like a limited partner, who's just given the money to the business and has decided that they're not going to participate in the management at all, they can be considered limited partner. However, the IRS has very strict tests, like the hourly safe harbor test, where if a member participates for more than 500 years during the current year, not considered limited partner. Primary participant, members' activity is substantially, if a business is, say, a small business and you don't require a lot of participation, you cannot say that, oh, it's less than 500 hours and, I'm excluded. No, it doesn't work like that. If your activity is less than 500 hours, but your activity is like the primary activity of the business, you are not excluded. And then there are a lot of tests, but yeah, there are exceptions to self-employment tax, but then again, you have to be very careful and make sure that you qualify under at least one of the exceptions. All right, so to summarize, this slide kind of lays out if you're a sole proprietor or a single member LLC, you will pay the taxes and the schedule, the supplement schedule that is applicable is Schedule C. Now, if you're a partnership or a multi-member LLC, you will report the supplement subchapter K or K1. And if you elect to be taxed as a corporation, you will be under subchapter C, subchapter S, or even subchapter T, which is beyond the scope again. And then corporation, C, S, T again. Now, at the end, it really, your choice of setting up your business entity, it really depends whether you want to be an employee of your business or you don't want to be an employee. So whether you choose to be taxed under Schedule C or under subchapter K, it really depends how you want your tax planning to go. Another important aspect that people generally take into consideration is whether you want to pay tax on the dividends. That is capital gain, capital losses. So in that case, you choose subchapter C, subchapter S, or maybe subchapter T. All right, now I'll hand it over to Todd.
Thank you, Neha. So yeah, just like I said at the beginning, at the top, we're gonna use the example of Social Security benefits, specifically. We'll be using the examples of the tests that the Social Security Administration, the SSA, uses. But this is supposed to also just, the intent is to give you a sense of some of the general ways in which issues around public benefits can come up in this context. Obviously, the rules will be different if it's, for example, like Section 8 or public housing, or state benefits, unemployment. There's a whole host of different regimes that have their own separate rules. But in a lot of ways, a lot of the sort of, there's ways of analogizing what those the issues are, and hopefully you'll get a sense of that from this one example. And we're doing this just for the sake of time. It's be too much. Focusing on benefits could be several series of webinars. We're using this as an example. Most people are used to, when you hear about the debates in Congress, federal Congress around Social Security, it's always about retirement age. It's currently age 65. you know, in addition, before, you know, after age 65 or even before, if you have certain forms of recognized, you know, if you have a condition that is considered a disability, a disabling condition, you know, for example, I have a listed, you know, on a condition that's listed on this, you know, the American Disabilities Act schedule. You can, if you qualify, obtain from Social Security benefits prior to the retirement age, either through SSDI and even the supplemental security income, SSI, which is more around, you know, need income. You know, there's also disability and income qualifications there. So we're talking about these, you know, benefits that will be coming during your working lifetime, not during retirement age. Next slide, please. So the main issue is that, you know, so for example, in this context, most, you know, means tested and needs-based programs are always going to be looking at, well, can you support yourself is sort of the conception, you know, can through your own self-activity, can you support yourself, or, you know, or not. And eligibility is oftentimes premised on that. So if there's this concept in the SSI, SSDI case around substantial gainful activity, the reason for that, you know, is that if the definition statutorily of disability is that you're disabled from engaging in substantial gainful activity. So the SSA wants to see, okay, you have this condition, but if you're actually still able to, you know, if you have SGA, then are you really disabled? You know, like there, you know, there's a lot of stigmatizing, you know, aspects to that, which we're not getting into. We're just describing the rules and the logic. And the main point is that if you do have SGA, that can go against it. You know, they can say, okay, you're no longer eligible, you know, while you're earning SGA. How the main question is going to be, how is the Social Security Administration going to figure out that you have SGA if you're not, you know, calling them up and telling them? So there's information sharing at the federal level between certain federal agencies. There's a lot of rules around how they share that information. But the main thing is that the IRS will share information on the Schedule FSE. And I believe it's all self-employment tax information that they receive that is reported will then be shared over with the SSA, especially, you know, post 1994. And I saw Neha nodding, so that's good. Next slide, please. So the point is that, you know, if you report to the IRS, they're going to share that with the agency that makes, you know, eligibility determinations for your benefits. Oftentimes that's probably going to come up to, you know, to an individual as like, well, should I just then not report it? You know, it's important to avoid tax audit risk. You know, the IRS there's been government reports coming out looking at where tax enforcement actually occurs in our society. And for a number of reasons, you know, there's maybe a disparate impact on small filers as compared to large filers. There's a possibility that things won't happen, but we're lawyers. We're going to tell you what you should do to minimize your risk, specifically audit risk and penalty risk. It's important to pay your self-employment tax, to accurately report self-employment tax and pay it to protect yourself. It's also important to pay into your Social Security tax, because your Social Security retirement benefits are calculated based on work credits. There's a complicated, you know, there's a much more to discuss here. The point being, like, if you're solely engaging in self-employment, it's on you to report that you're doing this self-employment as a way of, you know, obtaining Social Security retirement benefits when you reach 65. And so there's sort of good reasons why you would want to do it, to protect yourself and also to obtain benefits. You know, the question that, so rather than like, should I not report, it's how do you structure your business is what, we've mentioned that multiple times. When we say tax structuring or business structuring, we mean exactly making the choices, making the elections amongst the options that, for example, Nate has been, sort of summarizing at a very high level, and there are others as well, in order to it structures your relationship to the business. There's other options that are absolutely beyond the scope. So in the context of disability, there's something called the special needs trust. That is something that the SSA recognizes. It's a way of basically having all of your self-employment income or multiple sources of income are actually owned by the trust, and then the trust pays you on a fixed income. So it's sort of like taking the chaos of all the money that you're creating and turning that into fixed income, for your lifetime, and then there's stuff left over for for the next generation. You can also replicate a lot of those concepts in the corporation context, specifically C corporations, T corporations, which is cooperative taxation. The simplest thing to keep in mind that from a tax law perspective, that actually a CPA that at a great webinar I saw recently, some cooperative CPAs were saying, think of T corporations as nothing other than a C corporation with a special deduction regime for patronage, lower taxes on those dividends if you actually operate your C corporation as a cooperative. So the general concept, though, is that and you can't necessarily structure in the same way you can with a C corporation in the context of a pass-through partnership LLC. Neha mentioned how, gains and losses, which are changes in the value of the assets of the business, because those are passed through directly to you on your 1040, which for those of you who just use, the online tax filing things, that your 1040 is your individual personal tax return. It's the one that every person who reports to the IRS uses to report their tax return. Because gains and losses are flowed through to you, it creates complications of whether those assets, like legally the LLC from a state law perspective is separate, but there can be attribution in complicated ways that in the LLC pass-through context that don't apply to some of these other options. And that's why it's important to think about it in terms of like, well, I have all these options, not just pass-through LLC. There are solutions here that allow me to sort of cap my monthly income so that it's below the SGA. And the SGA is sort of statutorily or regulatorily determined each year. I think for 2023, it's like $1,400 a month. So if you structure the income that you get from your business in such a way that it is fixed and determinable, that it's a fixed income in a way that is below the SGA, you're going to have a lot more assurance, especially if you use something like a recognized tool such as like a special needs trust. You can structure your relationship to the income that your business earns by separating yourself a little more than you would in the context of a sole proprietorship or a pass-through LLC, which, going back to the original point about there's not really much of a distinction. There's no separation. By having that separation and structuring the relationship so that your interest in the revenues of that business are fixed income to you, that can be one solution. But again, I'm not saying, just to end with the final point again, that when we're talking about these types of this level of detail, it's a very searching, individualized analysis of the totality of your individual circumstances, and any solution would have to take the totality of those circumstances into account. So it's important to have a tax advisor that you trust enough to share all of your information with, tax lawyer or just a lawyer or a CPA, bookkeeper. And that's what I hope the point that this example draws out. And I think with that, we are now on the Q&A session. We open it up to the floor.
Excellent. I'm gonna give you guys your snaps. As members of this community, letting your light shine and showing the way. Very informative, high level, interesting. I think we increased participants the entire time. So somehow we are more now. So they heard about you guys. So maybe one question to kick it off, and then people can tune in to make it really extreme. If I have $1 million company, but I had, I'm a veteran, or I have a condition that was listed on the list of disabilities that might allow me to access some of these services. That's not going to matter. $1 million company, and I structure the payments till I get $1,200 a month.
Hard to say in the again, totality of circumstances, but there are people that receive disability benefits who have $5 million companies. There are people in public housing that maintain their eligibility in public housing that have businesses that are, maybe the revenue of the business, I'm not necessarily speaking of like the profits in an abstract sense, but it's a $5 million business. It's worth a lot of money, but because they use something like a special needs trust and ensure that the thing to keep in mind is when you do something like this, what you're basically saying is, I'm irrevocably disclaiming ownership of the equity position, in at least not in terms of control and governance, but in terms of the amount of money that I'm going to get out of it. And I'm, sort of tying myself to the mast of, the Homer's ship or whatever, and saying, because I'm not going to be able to access this additional money beyond my fixed income, you don't need to take it into account in looking at whether I'm earning, above the rate that would otherwise cause problems. Whether it's the 30% of income for housing benefits, for example. The point is that you it's not just about like papering over or like making it look like, you're really making a decision to say, okay, I'm building a valuable business that I want to be valuable for, my children, maybe, my community. But for me, my financial benefit in this is going to be, irrevocably capped. And the reason for that is, there's policy reasons that I don't necessarily agree with and completely, but it sort of gets at that idea of, well, if you really are making that much money and you're living off of that money, why what's the argument that you need to be supported by the collectivity, by taxpayer dollars or whatever.
Gotcha. And I can see the extreme case of it against race for the individual, but I think the more practical application could be, for example, Kumba Collaborative on the call, right? Let's say we have a real estate, a piece of property valued at, $1 million. And I'm a lady in that neighborhood, and I've been invited to participate in that housing cooperative, whether as a member or, a residential member, or as an investor, community investor. So I had to pay $100 to be a part of this. Now I own a piece of company that owns a real estate valued at this amount, and I technically am a co-owner in $1 million company, so on and so forth. So these are some of the real life implications that could happen, even though I'm not necessarily going to get a dividend, right? There might be 1,000 of us, et cetera, right? People might be scared of paying $50, $100, knowing they collect certain benefits to be associated with that, right? And we might fear success. So that's an interesting thought I had, maybe from the extreme.
Yeah, and I think that, to your point, like every context is going to be so different that I do want to caution against, like, but the point being that there are options, and and with advice, we can look at what the best option to still satisfy the goal would be. Neha, did you want to jump in? I saw you playing with the slides.
Yeah, I just wanted to say that at the end, it basically depends on how your income from the co-op will be reported. Because the SSA will have different kind of tests, which we've not gotten into, due to time constraints and everything. So there is an income limit, there is an asset limit, and so on. So just being a member of a co-op or just getting $100, $200 dividend, I don't think so that it should affect your benefits at all, provided it's reported correctly, everything is clear on your taxes, like where is that income coming from, and you're reporting everything to every applicable agency.
Gotcha. Appreciate that. And I want to invite folks, if you have a question, there's no wrong ones. This is the space, we're in community. Get it out. We've got about another 5 minutes of question and answer. And I would also encourage you to drop it in the chat or to send it in an email, and maybe we can forward it and see what happens in a future conversation to see if some of them could be engaged. So if you have anyone to give you the opportunity to ask it, come off mute or just drop it in the chat.
Yeah, I had a question. If anybody, I don't know if anybody has experience in it, but what does it look like to convert like a general partnership LLC into a cooperative? Does it require a dissolution of the LLC and then a reformation in another way, or what does that look like, I guess?
So this gets into the the pathway for an LLC. The IRS has, through private letter rulings, which are not they're not legal precedent, but it shows how the IRS has looked or ruled on in individual cases in the past. With the IRS's private letter rulings around LLCs being a co-op, and co-op here, I assume we're meaning a tax cooperative, get the patronage dividends, getting that special deduction, moving out of pass-through. So what the IRS says for LLCs is LLCs, in the same way that LLCs can elect to be C corporations, LLCs can elect to be T corporations, and they use the same process. I think we actually show one of the slides later, like electing. So like you would send in a check the box saying, I elect to be classed as an association. So this is the one for S corporations. Might be specific to S corporations. There might be a separate one for C corps. No, this is the one. Okay. So you elect to be taxed as an association, as a C corporation. Don't do S corps for reasons which we can't get into, but it was something that the co-op CPA said. There's a bunch of right answers and one wrong answer when it comes to cooperatives, and that one wrong answer is the S corporation. You elect C corporation treatment through this form, the check the box rules, and then you simply file on a cooperative basis. So a C corporation files a tax return, an actual tax return, not just an information return like this 1065, but the 1120, which is similar to your 1040. It's like the actual tax return. The cooperatives file an 1120-C, excuse me. So it's just a separate corporate tax filing form that is specific to cooperatives. And then the test is going to all come, you know, the IRS scrutiny around your eligibility for T corporation treatment is whether you are in practice meeting the IRS's definition of cooperative, acting in a cooperative manner is this statutory language, I believe. So you literally have to just, you know, be member owned, democratic governance, and you have to allocate, the, you know, the profits of the corporation in accordance with patronage concepts. And one of the critical legal drafting, you know, pieces is defining what patronage means in the context of your specific your LLC cooperative, or in any cooperative. You know, patronage is a labor-based dividend measurement. So like traditional dividends is how much of the total capital stock did you invest? That's your percentage ownership. And then, so if I'm a 20% owner, I get 20% of the dividends declared. I'm simplifying here. A patronage dividend is different in that it's based on use rather than, you know, investment. And so you know, an hours based, a laborers based patronage is a very, you know, common thing for like worker cooperatives, for example. So I provided 20% of the total hours that were, you know, of total labor that occurred in the cooperative. So I get 20% of the dividends because I use the cooperative as a worker, you know, more. There's in a consumer or producer context, you can have volume based, you know, how much did I shop at my food co-op in a year? Although most food co-ops don't do patronage in this way. Or if it's a producer like a farm cooperative, what volume of grains, of the total grains that was sold in the, you know, of the nursery plants that we sold, you know, my farm was 40% of that. So you get 40% of the patronage income that comes from that line of business of nursery plants. But to answer, you know, that was way more than what you asked, but to go back to your specific question in summary, you elect C Corp status and then operate on a democratic, you know, in accordance with the IRS definition of cooperative, in this way. And oh shoot, there was another important piece that I was going to say that just slipped my brain. If it comes back to me, I'll hop back on.
Thank you.
Oh, that's what it was. So the election, so the IRS rules around electing of switching between entity types for LLCs is, I believe, it says every 6 months you can make that election to come in and out. Now, you want to be careful. Electing from individual into corporation has tax consequences, especially around the ownership of assets and things like that. You basically set the initial basis, I believe, for most of those assets when that happens, or maybe it takes you know at the basis of anyways, Neha could clarify that. The issue becomes when you elect out of an association into pass-through, that can have significant tax issues. I've heard in the past. I'm not, you know, I'm somewhat speaking from ignorance at this point. So, you know, I'm just repeating principles I've heard. But the issue is that, you know, making these elections back and forth, you have to take into account the capital gains treatment of assets and how it will impact those assets. And that's the role of a tax advisor to help you determine. I mean, generally what I was told, you know, as a general rule, not in the co-op context, but just in general, you can elect into C Corp, but once you're in C Corp, you can't ever really elect back out because the tax consequences are going to be absolutely devastating.
Okay.
So be careful when you make that decision that it's the right one for you, that you're committed to that plan. Because otherwise, because it may be irreversible in the absence of what you said, which is sort of liquidating the existing business, transferring its assets over, recognizing gain and loss, clearing things out, and starting all over with a new entity. In order to avoid that hassle, just, planning, always planning, 5-year plans, 50-year plans, whatever it's going to take to get your business in the right mindset.
Gotcha.
All said, Pat?
I mean, yeah, I mean, I can keep going.
Well, we'd love that. It's interesting. We're at 11:30, and some of us may have to go. I think for the purposes of the presentation, we can close this portion and engage the rest of the agenda, which might take another 10 minutes to hear a little bit of updates about upcoming events and if anyone has any other resources they'd like to share. So again, want to give you guys some snaps, as members of the community, as guests. Really appreciate you guys taking your time. I think this is going to be really valuable. All right. So excellent. Thank you in the chat. If you have questions, continue to shoot them, and hopefully we can just keep the conversation going. For the next portion, we can de-emphasize the spotlight on Todd and Neha, and we can invite up Swain to give us an update about this Thursday's COP kickback, as well as anything else related to the ERC and other fellowship business.
So, and sure, good morning, everybody.
Hey.
That was definitely a prompt for some verbal response back. Good morning, everybody.
Good morning.
Yeah. So yeah, we're gonna be at Pure Juice Cafe at 864 Madison Avenue this Thursday from 6 to 9. It's owned by councilmen in that district in Albany. But pretty much, yeah, we're gonna literally kick back. It's gonna be informal. We'll pretty much kind of have some of these conversations like this. Pat, I do like how you worded your question and kind of transitioned it into it's like we want to do some more of that. But in real time, pretty much the energy that we had on here today, it was great. Neha, it's nice to meet you. Todd, thank you for everything always. Johan, you're always great at facilitating. But yeah, we'll be over there chilling, kicking back. There's a TV. I think the ping pong table is still gonna be there. I thought it was at Kickback Studios. That was the last one that we scheduled. But we haven't scheduled any future engagements or programming at Kickback Studios yet.
Gotcha. Appreciate that. Anything else, Wayne, regarding the ERC or any other updates for people to tune into? Or?
I mean, nothing yet.
Okay. No problem.
Just pretty much what we got coming up. I had a meeting with Pat. We're gonna schedule some stuff out as far as the walking tours and things like that out for later on in the year.
Gotcha. All right. So I appreciate you. This Thursday, as Swain said, we're gonna have a co-op kickback, just an opportunity to get together and hang out and engage more curiosities. If folks are able, tell a friend and we'll see you there this Thursday at 6 at the, what's it called, the Madison Cafe? Swain, what's it called again?
Pure Juice Cafe, and I'm about to drop
Pure
the link.
Juice Cafe. There we go. On Madison.
Yep, I'm about to drop it.
Madison. Thank you. Meet the Fellows was awesome. For Ryan's question in the chat, we'll have a recording. We'll shoot that around, and we'll try to get this recording available as soon as possible. Work with Pat and the rest of the team to get that, and we'll shoot it out to the community as well as the Meet the Fellows. So I think those will be two interesting ones you guys really want to tune into. Any final comments on the presentation or questions on the kickback before we go into dismiss, which is just inviting people to share resources as we exit the call? All right, we got the link in the chat, so that's fine. Just want to invite people to share any resources or any calls for support for projects or ongoing initiatives, and After that, we can dismiss. You guys can go enjoy this beautiful day. Anybody got anything going on you want to call attention to?
I think on the 19th, April 19th, I think we're doing a workshop, developing your brand concept. So if you know anybody that needs some help with that kind of thing, I think Jamel will be running that one. So you'll see some graphics for that in the next like week or two.
April 19th for the comments in the chat. All right, appreciate your Pat. Anybody else?
We had like a special project we just did with a cooperative sports league that's starting up that I thought was just interesting that I'd just give a shout out to. They're based out in Florida, but it's like a nonprofit cooperative inline hockey league. And I just thought that was interesting, like in terms of like talking about different entity types for cooperatives and things like that, and just like different types of businesses / ways to engage with the community. It's called the Tropical Hockey League. And I guess they're basing some of their stuff off of the Green Bay Packers, which is kind of like fan owned, which I didn't realize until like diving into this stuff. And I don't know, it's like an interesting project we worked on. We just wrapped it up. And other like fun facts, the NFL is like one of the few like major sports leagues that's also like a nonprofit. It's like categorized as a 501c6. So I guess like the individual teams like pay the taxes, but I mean they deal with like a lot of money. Roger Goodell I think makes like 30 million a year or something. But anyway, this organization, I don't know who put them on to us. They said somebody recommended them to us. So they don't have any like financial activity or anything like that, but they're trying to raise funds through WeFunder, and they're looking for like reviewed financial statements, but we're not a CPA firm, so we don't do reviews. And they also didn't have any financial statements. So we put together this like assessment that's sort of like, it doesn't use the word review or describe itself as a review. It's just like an assessment of the organization based on a number of interviews. But I don't know. We'll see how that goes, because WeFunder requires like reviewed financial statements to be put it on their website for funding. So I don't know how that's going to turn out, but I just thought it was something interesting that we were working on that I thought I'd share and see if anybody here knew of this organization or suggested we work with them. It wasn't clear. They said somebody in the co-op world, so I don't know what that means.
That's awesome. That's awesome. I would love to hear more about that, and maybe even dive deep into how the reality of the corporate world is pretty cooperative. At the top, they make sure they work together to keep the business going and get that money. So I think that'd be really interesting to deep dive into the Tropical Hockey League. Wow, interesting. Excellent. Any other updates? And maybe we can talk about a financial deep dive for next month, Brian. I know we had mentioned it, it's on the queue. Maybe we can explore some concepts, invite somebody. Let's talk about it at the final Friday team meeting or before. Cool. So if you got anything, there's something else in the chat. Mission accomplished, transition services, hiring. So make sure you share that. I know a lot of people would benefit from the opportunity, and be on the lookout for the recording. Thank you. Everybody go enjoy the rest of the day. Try to get these to you as quickly as possible.
Yeah, have a good one.
Peace out, everybody.
Thanks, yeah.